Good afternoon, everybody, and welcome to Gray Gray's McDonald's Year-End Planning Webinar. I'm Mark Kashkagian, Director of our firm's McDonald's Practice Group. We're very pleased to have so many McDonald's owner-operators from around the country with us today. We appreciate all of you for taking the time for this informative presentation. I hope that you will learn more than you expect today. Before we begin, I'd like to give you a little background about who we are and our long relationship with McDonald's franchisees. We've been working with owner-operators for over 50 years now and have developed a very specialized and dedicated McDonald's practice group. We provide all the services you'd normally expect from a CPA firm, including what we call compliance work, accounting and tax, but we go well beyond that for our McDonald's clients, well beyond the numbers, to include all the financial analysis and reporting that is specific to McDonald's owner-operators' needs today. As a result, we've become the leaders in accounting services for McDonald's franchisees across the country, working with dozens of owner-operators on everything from business planning, reinvestment strategies, personal financial planning, and the like. McDonald's is a vital core to our business, and we have become just as vital as a trusted advisor to our clients. Now, on to today's topic, year-end planning. And I'd like to introduce our presenter today, a senior tax partner at Gray Gray. His name is Mike Koppel, very well known in the McDonald's industry. One technical point before we begin. If you have a question during the presentation, please press the raise your hand button on your screen. We will get to that question either right away or a little bit later in the presentation, whichever is most appropriate. And without further ado, I'm very pleased to present Mike Koppel.
Okay, we have a lot to talk about in the next hour or so, so let's get going. There is my ugly picture, but more important than that is all of my contact information is there. And you can reach me in any one of these things. I check my Gray and my personal email fairly regularly throughout the day. Obviously, our office telephone number and my direct number at Gray is there. Also down the bottom is my cell phone number, which I give out to anybody that wants it. And you can pretty much almost always reach me on my cell phone if you have something that you want to talk about or whatever. And I have no problem with you calling me on my cell phone. Those of you that know me know that I have a couple of rules. My first rule is that it is my feeling that as the presenter / speaker, I should avoid making political comments. You can make a political comment if you want to, as long as it's not too political and too politically charged. We're in a politically charged environment today, so we do want to try and keep it fairly civil. The other thing that I want to make sure everyone knows is yes, I am a tax geek, and I live and eat and breathe and spend a lot of time doing taxes. But what we have to remember is that you are business people, and you're in business to make money, and you make money making economic decisions. And a tax decision should never dictate what your economic decision is. And if you have questions about how that interplays or anything else, feel free to call me or call Mark, and we'll be happy to talk about that. There are some specific items I want you to pay attention to as we go through this presentation. Number one, I hope this applies to all of you, and that is who qualifies as rich. The tax law now has several definitions of who is rich and who is going to have certain things happen to them when they lose benefits or have additional taxes put upon them because they are rich. And what's important here is to take a look and see that there are several definitions and where they kick in. The next thing I want you to understand is as we're looking at that, there is something that has crept into the code in the last few years, and that is something that we call the marriage penalty, where a couple very often would be better off being single than being married. And because they are married, they could incur significant tax penalties. And we're going to try and point that out and show that as we go through, just so that you understand what it is when people talk about the concept of marriage penalties. Towards the end of the discussion, all right, we're going to talk about what the effective marginal tax rate is. And if you have a paper and pencil around, or a little calculator or whatever, try and keep track of what you think the top marginal effective tax rate on an individual is. And we're going to talk about why that's important at the end. And the very last thing we're going to talk about is what may be coming down in the years ahead. I have the honor and privilege of sitting on the AICPAs, which is the National Association of CPAs. I sit on their committee of tax reform, so that I have the dubious distinction of being able to talk to various people in Congress and the Congressional Budget Office and everything else as to what is happening and what they're thinking and things along that line, which is kind of interesting. If those of you that keep track of those things, which is probably none of you, just idiots like me, one of the interesting things is that Chairman Backus in the Senate just released the first of his white papers, the first of his position papers, dealing with his concept of tax reform. It's very, very limited what he issued, only an international tax, which probably doesn't affect any of you. But clearly what is happening is both Chairman Backus and Chairman Camp in the House do intend to move forward with some type of tax reform, and we'll talk about that briefly at the end. So why is all of this so important? Let's talk about the first thing that's happening, is that a lot of you understand there's a concept in tax called 179, for Internal Revenue Code Section 179, which allows you to immediately expense assets that you buy. And right now, today, 2013, you can immediately expense up to $500,000 of assets that you purchase, and that doesn't phase out until you have asset purchases of over $2 million. So for the vast majority of owner-operators, you're able to expense $500,000 of fixed asset additions every year. Now, why is this important? If nothing happens, if Congress does not act, what's going to happen in 2014, instead of that being $500,000, it's going to be $25,000. Now, as we talk about these things, and these are called extenders, the things that are extended sometimes every year, and sometimes they change a little bit. What I have been told unofficially is that 179 is going to be extended, but probably extended in a significantly lower amount. We don't know what that amount is going to be. We probably won't know what that amount is going to be until sometime next spring to take place retroactively, which is not good news, because you as business people and me as a business advisor, what we like is we like to know what it is we're talking about, and not having things until months after the fact doesn't help. The second thing that you're using is what's called bonus depreciation. And a few years ago, you could have 100% bonus depreciation. You could depreciate 100% of new asset acquisitions. In 2013, you were able to expense 50% of new asset acquisitions. Bonus depreciation expires at the end of this year. What we have unofficially been told is that bonus depreciation will not be coming back. That doesn't mean things may not change, but as of now, as we talk to people in Congress, bonus depreciation is not available. It does not appear that it's going to be available next year. 15-year depreciation, as you people know, restaurants, retail, leasehold improvements are able to depreciate those additions over 15 years. What's happened is that once again goes away. What we have again unofficially been told is that that will probably be renewed, but there is no definitive answer there, and it may be renewed at 25 years instead of 15 years, as opposed to the 39 years that was going to happen. So this is something we have to also pay attention to. Now, there's lots and lots of other extenders. There's an excess of 50 tax provisions that are going to go away at the end of this year unless Congress does something. I'm not going to go through all of them, but there's all kinds of things that are in there that are very, very important. And again, we probably won't know what's going to happen to most of them until sometime next spring. Congress has other things on its mind right now, so we'll see what happens. We'll be keeping you informed as things go forward. But there are some other things that we want to talk about that are very, very important, that we believe are very, very important to you as McDonald's owner-operators and to other business people as well. The first of these is what's called the repair regulation. Why is this important? This is important because as of years beginning on or after January 1st, 2014, which is just about every McDonald's owner-operator that I know, there are new repair regulations. There are new rules as to what must be capitalized, what goes into your 179, what has to be expensed, and so on, all of which takes effect on or years beginning on or after 1/1/14, which is right around the corner, which is why this is so important. Now, please understand, this is an incredibly, incredibly complicated area. We could spend an entire day talking about just the repair regulations and how they work and why they work and so on. We're only going to spend 10 or 15 minutes talking about this. If you have additional questions about it, feel free to reach out to me. Feel free to reach out to our tax department or our franchise department to talk about it. It is something that you're really going to have to understand because the IRS is going to be enforcing this starting with next tax year. So it's major, major changes as to what's going to be capitalized. Now, I don't know if there's anybody out there that speaks Latin, but what the word de minimis actually means is small. So basically what Congress has done, or what Treasury has done in this case, is they have set up some de minimis rules. And in this case, de minimis doesn't really mean small, it means safe harbor. So what they've done is they've set up some safe harbor rules. And fortunately, none of you are here with me, so none of you can throw things at me as we talk about this. All right? At the end of the repair regs, we're going to talk about what an applicable financial statement is. I will tell you that to the best of my knowledge, no McDonald's owner-operator that I know of has an applicable financial statement. That may be wrong. There may be somebody out there that does, but we'll talk about exactly what that is at the end. The first de minimis rule is that if you have an applicable financial statement and you have a written capitalization policy as of 1/1/14, theoretically the capitalization policy is supposed to be in place, in writing, as of the first day of the year. If you have both of those things, you can expense any asset acquisition of $5,000 per asset or invoice, period. So if the invoice or the asset that you purchase is $5,000 or less, you can immediately expense it, no questions asked. However, none of you that I know of have an applicable financial statement. But what you can do is you can have a written capitalization policy. Now, the rules don't say that you have to have this in writing. It is my position and the position of all my tax friends that we want to have this in writing because we want to have it consistent. Now, what we are doing is that in addition to being members, most of you know we are members of NAFCA. Gray, Gray & Gray is also a member of another association called CPA America. And CPA America has formed an elite group of tax professionals. And what we are doing is we are preparing, and hopefully I will do my part this weekend and send it off to one of my buddies who's going to proofread it, that we're going to have a pro forma capitalization policy probably for the week, by the weekend after Thanksgiving, that people will be able to use, and we'll be distributing that sometime the end of November or the beginning of December for people to be able to use so that they'll have it in place so that they will have their capitalization policy by the end of January, by the beginning of January, so they will have that in place. But how much is it? Instead of the $5,000, you only get $500. So that's any asset or invoice that is $500 or more. If you have that capitalization policy, you're able to expense. If you have neither, if you do not put the written capitalization policy in place, the safe harbor drops to $200. All right? So that basically what we're saying is that we believe that it is really important that you make sure that you have this written capitalization policy in place by the first of the year, and we'll be working with all of you to try and make sure that you have that in place. All right. There are annual elections that you're going to have to make. Theoretically, you're not going to have to worry about this for a year or so. You're going to have to every year make an election to use the de minimis, which we hope is going to be some kind of check the box whether or not which one you have of this. And then there's one other thing. Now, some of you actually own your stores, and a lot of you have offices outside of your stores, but you also own some of your larger owner-operators. Now, there's a very interesting part of this, and that says that if you make the proper election, you will be able to expense a partial disposition. And I'm going to use a real estate example because that's the most common one and the easiest one to present. So let's suppose that you have an office building that you use for your stores outside of the stores. And let's suppose that you put it in place and it has a 39-year life. And after 20 years, the roof has to be replaced. Now, the way the rules currently stand is that if you have to replace the roof, you cannot take the cost of the original roof and expense what's left. What you have to do is take the new roof, put that on, and it's either 15-year or the 39-year life that's going to have to be. If you make the proper election starting next year, or if it happened in 2013, you could actually make an election to apply this in 2013, you are able to go back and say, okay, I'm going to take whatever value is left in that roof. I'm going to go back, determine what the cost of the roof was when I first put it in, how much of it would have been depreciated, and anything that is left I can take as an expense in the year I put the new roof on. And that's called a partial disposition. Obviously, it's much more complicated than that. It's an election that has to be made. It is something that if that happens, you should actually talk to us. If you have any other partial dispositions, for example, again, please excuse my lack of knowledge in this area. But, you know, if a major part of a grill or a major part of a freezer, for example, were to happen, this is also something that we should be talking about with regard to partial dispositions. Now, I don't, you know, obviously there are a bunch of you on this call. I don't know the size of all of you. I know a few of you. Let's assume that an average McDonald's store, and I understand that there's no such thing as an average McDonald's store, but let's assume that an average McDonald's store does between $2.2 and $2.5 million a year, which is kind of the numbers that I hear thrown around. Basically, there is a small business exemption, and this is not great, but at least it exists. What the small business exemption says is that if you have average revenues, which is a moving average of 3 years, of $10 million or less, which would kind of talk about, you know, probably a 4-store owner-operator for most places. If you're $10 million or less, then you can take for an improvement, not new assets, improvement of your assets, a great $10,000 or 2% of the unadjusted basis of the property you're improving, you can expense. This is not great. It is something that those of us that were writing to Treasury and the IRS regarding this, it is something we fought very hard for. We got a little bit. We didn't get anywhere near what we want, but this is something that is clearly in place, and it is once again an election that has to be made, and it's something that we'll be making on all of the 2014 tax returns. There is also an exemption for real estate. That doesn't apply to the vast majority of you. If you do own significant real estate and you want to talk about the real estate exemption, you know, give us a call and we'll talk about how that works. When the original temporary regulations came out, there was a possibility of like 120 accounting method changes, like everything was going to happen. One of the things that Treasury has told us is that we are going to be receiving significant additional information regarding the repair regulations sometime between tomorrow and the end of January. So there's a lot more information to come. As it comes down, if there are any significant changes, we're going to let you know. it is something that we at the AICPA and other organizations are trying to influence, and we'll see what happens over the course of the next few months as to whether or not we're able to influence any of this to make it better for you. Now, please notice my little graphic here. Now, if you remember, I said when I first started this that I didn't think any McDonald's owner-operator that I know of, and there may be some out there, had an applicable financial statement. Step number one of an applicable financial statement is it has to be an audit. So if you don't have an audit, it's not an audited financial statement, audited by a CPA with a CPA's audit report and so on. If you don't have that, you do not have an applicable financial statement. You don't even come, you don't go any farther, and the $5,000 is not going to apply to you, which is why we still want to have a policy in place so we can get the $500 instead of the $200. The AICPA and other organizations fought very, very hard to try and get reviews or even a compilation complete with footnotes there. But basically, Treasury would not give in. They will only go along with what was there for an audit. If you have questions about it, what is an applicable financial statement and why and so on, feel free to give me a call and I'll tell you what we tried to do and why we failed. I want to move on to a different topic, and that topic is net investment income. It is one that is very, very important to me and is going to be very, very important to a lot of you who are very, very successful business people and owner-operators. And the reason that it is important to you is because what this is it's a 3.8% surtax. Right? That's a tax on top of your other taxes on net investment income. Right? And net investment income is for anyone that has adjusted gross income. It's modified adjusted gross income, but I don't think any of you have any of the modifications. It's adjusted gross income, which is the number on page 1 at the bottom right-hand corner. All right, so look at your tax return, the bottom right-hand corner. If that number, if you're single, first definition of rich, is $200,000, or marriage filing jointly $250,000. First time we see a significant marriage penalty. If that is the case, then you're going to be subject to the net investment income tax. And net investment income tax is considered to be any interest, dividends, rents, royalties, annuities, and capital gains other than capital gains for the sale of an operating business in which you actively participate. Now, earlier this year, I think it was in February, we did a webinar. I did a webinar on the difference between passive and active and all of the things that came in there. As long as you actively participate in a business, the capital gains for the sale of the business or sale of those assets, there are certain things you're going to have to do, but they will not be subject to net investment income tax, as opposed to if you sell your McDonald's stock, which would be a capital gain and would be subject to the net investment income tax. Before we move on too far, though, all right, the gentleman with the sword is me, and you can figure out who the dragon is. One of the other things that I've been doing this year is that I had the privilege of writing the AICPA's position to Treasury with regard to self-charged rent and interest. And if you, for example, if you have an office outside of your stores and that you own and you're paying rent to yourself, basically you're taking money out of your left-hand pocket and putting it into your right-hand pocket, and that's called self-charged rent. Because what we and most other business advisors do is that if you have an office or whatever, that even though it is directly tied to your operations, we suggest that it be owned outside. So basically, that's self-charged rent. And if there is rental income there, the Treasury's position is that it is rent the way the law is written. Even though you're just paying yourself from one pocket to another, you're going to wind up having to pay net investment income tax, an additional 3.8% surcharge on that rental income if there's rental income from that operation. What I've been advising people to do is to take a look at how much rent has been paid. If you think you have already had fair market rent, however you want to define that, don't pay any more rent this year, because all you're going to do is have to pay the surcharge on it. Yes, you get a deduction on one side and income on the other, but for 3.8%, there's no reason why we should have to be paying that. If you have a lease, talk to your attorneys, change the leases, have them give us a call. We can help you with that situation as to what you should be doing with that area. We are still fighting the good fight to try and change that in the final revenue procedures. It does not appear that we're going to win, but we are continue to fight the fight. A lot of us, and a lot of people have set up trusts for the benefit of their children or grandchildren or whomever. Now, when we talked about the net investment income, we talked about the income level that was needed and the $200,000 and $250,000. Trusts are a different animal. All of a sudden, in a trust, this happens when the 39.6% income hits a trust, which is just under $12,000. So if you have set up trusts for your children or grandchildren or whomever, one of the things that we want to talk about as year-end approaches or right after year-end is if there is significant investment income in these trusts, we should be talking about whether or not we should be distributing money out of those trusts to the beneficiaries in order to avoid the 3.8% additional surtax. There are reasons to do it. There are reasons why we shouldn't do it. And there are lots of things that we should be discussing in that area. And once again, you know where to reach me. You know how to reach people in the office to discuss that. It is something we want to talk about. 3.8% is a pretty significant number. It is something that obviously we want to avoid if we possibly can. Now, I don't know if there's anybody on this call who is from Texas. I do not know Carol Warley, who is the president of the Texas Society of Certified Public Accountants. I sent her an email. I was able to look up her email, congratulating her on her statement. Several months ago, the IRS issued in draft Form 8960, which is the form that is used in order to calculate the amount of net investment income that is going to be taxed for individuals, estates, and trusts. And it was a very interesting form, and what was really interesting about it is that after every line on the form, it said, see instructions. Now, there's an issue. The issue is there are no instructions. And the reason there are no instructions is because in order to have instructions, the regulations have to be issued. And the regulations aren't issued, therefore the instructions can't be issued. And what Ms. Warley basically said is that CPAs are unable to effectively evaluate the form without seeing the proposed instructions, which have not yet been released. And like I said, I sent her an email congratulating her because I thought that was an absolutely brilliant comment with regard to this form. So that basically what I'm telling you is that in 2013, you are indeed going to be taxed on any net investment income you have. As of now, we don't have the instructions. We don't have the regulations. We think we know how this is going to be calculated, but we can't be sure. And once again, we have been told we'll have this by the end of January. So that, when that finally comes down, we'll make sure that we let everybody know exactly how this thing is going to come down. That's not the only surtax. There is a second surtax, and the second surtax is on investment income. It's on earned income. It's an additional Medicare surtax. Right? And basically, this is not 3.8%. It's only 0.9%. My comment to people is this: 0.9% of $100,000 is $900. My wife and I, the wonderful Tina, and I could have a very nice, a reasonably nice weekend somewhere for $900. So if you want to throw $900 away, I'll be happy to give you my address up here in the mountains, and you can send me the $900. But there's some very interesting things about this provision and how it works. Now, owner-operators, some of you are organized as S corporations. Those of you that are organized as S corporations, you know that some of your income you take out as wages, and some of it you get as a distribution of income. The way the law is written is very, very specific. The wages that you take are considered earned income. The income distribution that you take on your K-1 is not considered earned income. So that what I'm sitting here saying is that you really have to take a long, hard look, depending upon the ownership of your business, if you're an S Corp, and so on. You really have to take a look at how much you're taking out as wages. Please understand the tax law is very clear that the owner employee of an S corporation must take reasonable compensation. Reasonable compensation is not defined anywhere. But what we have is we have several cases where people really have taken that which is clearly almost de minimis wages, and therefore that's been not considered reasonable. We're going to have a whole nother animal here where the IRS in 2 or 3 years is going to be coming in and talking about whether or not the amount of compensation that somebody is taking is reasonable or not. Please give me a call, give somebody else a call if you're an S Corp, and we can talk about how much you should be taking out as wages and how much you should be taking out as a distribution of income. Now, LLCs are another animal. And my example here that I like to do, and long ago, and I guess I'm showing my age here, long ago there was a movie called Under the Thunderdome, which was a Mad Max movie starring Tina Turner. And Tina Turner had one of the great lines, I think, in all of moviedom. And basically what she said is the rules are, there are no rules. And I have a great story, but it takes too long to get into. But basically what this says is that as an LLC, there are no rules. Starting in about 1999, what we started doing is we started doing something called bifurcation. And any of you that are our clients, that are LLCs, know what we're doing, and most other quality CPA firms are doing with bifurcating. What we're doing is we're setting up the LLC so that you are a 1% managing member and another percentage, a larger percentage, where you are a non-managing member. And then we give you a guaranteed payment, and we have something that is written into the operating agreement in order to defend all of this. So what happens is the 1% managing member and your guaranteed payment is considered earned income, subject to self-employment tax, subject to the earned income surtax. That which you receive as a non-managing member is not considered earned income, is not subject to self-employment tax, is not subject to the Medicare surtax, and is not subject to the 3% net investment income tax, which is the best of all worlds. I've defended this position 25 or 28 times in the last 14 or 15 years. It takes me about 3 minutes to defend. I win every time. It is something that if I was teaching a seminar down in Connecticut on Tuesday, and I was discussing this, and I was amazed that there are actually some people that aren't doing this. If you're not doing this, if you don't understand this, give me a call, give somebody in our tax department a call, and we'll be happy to talk about bifurcation and how it works and why it works and what should be included in your LLC operating agreement in order to make this work properly. And once again, just like your other surtax, this applies to rich people that have earned income of $200,000 or marriage filing jointly of $250,000. Now, notice what happens with a marriage filing jointly here. If you have a couple and each of them earn $175,000, if they were single, they would not be subject to the earned income surtax. But because they are married and each one earned $175,000 and they have a total of $350,000, they have $100,000 of additional 0.9% income surtax that they're going to have to pay, which is, whatever. I want to talk about estate and gift very, very briefly. And what I want to talk about is lots of people are talking about the federal estate tax. We all know that this year the exemption is $5,250,000 per person. We understand that there's portability, which means that the husband and wife together, if the husband doesn't use it, if I'm off hiking and get eaten by a bear up here in the mountains, Tina is going to have $10.5 million. Discounts still apply, grants still apply, intentionally defective grant or trust still apply, et cetera, for federal purposes. So that actually you can have an estate that's worth about $16 or $17 million and not be subject to a federal estate and gift tax. However, about 33 states do have either estate and or gift taxes. There are only 2 states that have gift taxes. If you're in Connecticut and Minnesota, give me a call and we can talk about the gift taxes in your state. The other states actually still do have estate taxes. So those of you, for example, that are in Massachusetts, well, our exemption is only $1 million. So that basically if you have an estate in excess of $1 million, you're going to wind up with an estate tax in Massachusetts. There's no portability. So that what we have in Massachusetts, and I'm using Massachusetts as the example, that's where Gray obviously is located. If that's the case, you can have up to a 16% estate tax in Massachusetts. So that there are things that we have to do, not necessarily for federal gift and estate tax purposes, but we have to pay very, very close attention because of what happens in the states, where there can be a very significant state, estate, and or gift tax situation that we have to take care of. Capital gains and dividends, I have bad news. Basically what happens here is that if you make more than $400,000 or $450,000, what you're going to wind up having is that your capital gains rate is going to be 20% and your tax on dividends is going to be 20%. Plus, in all likelihood, you're also going to wind up with a 3.8% net investment income tax. So what you're going to wind up with is, instead of 15% what you had in 2012, starting in 2013, you're going to have a 23.8% tax. So all of a sudden, you're going to have almost a 60% or approximately a 60% increase in your capital gain and dividends tax rates. That's why you see a lot of people talking about a concept called capital loss harvesting, taking a look at your portfolio. If you have a stock portfolio, taking those losses in order to minimize your capital gains, minimize the amount of tax that you're going to have to pay in that area. It's really very, very important that before the end of the year, you sit down with a very, very qualified financial advisor. We have Danny Romano and his people at Gray that will be happy to help you, or you call me or somebody else. It's an awful lot that you have to take a look at here, because all of a sudden when you start talking about 23.8% on dividends and capital gains, that's a pretty hefty amount of tax. Now what's interesting is that it did not change from the 25% or 28% on recapture and collectibles. Those didn't change, interestingly enough, but they did for other capital gains and dividends, and it's something that requires an awful lot of planning, because all of a sudden now this is truly, truly becoming extremely expensive. One other thing I want you to remember, and this is really important for those of you that are considering next gen and succession planning, is there's it's a quirk in the law, if you will. And what the quirk says is if you sell your stores, if you sell assets to your children, to a related party, you don't get capital gains treatment. It's ordinary income treatment. So that all of a sudden, you're going to be taxed at 39% instead of the 23.8%, which is a huge difference. This has been around a long, long time. There are several organizations that are working very, very hard, telling Congress, and this is the law, so it has to be through Congress, that this doesn't make sense, that it is detrimental to family business, and that are fighting to have this changed in tax reform or some other form because it just doesn't make sense to be punishing family business in this way. You'll notice my little graphic down the bottom, my little bunch of bananas. What's important, and the reason I have it there, is that what we're going to talk about a little bit is the phase out of itemized deductions, where some of your itemized deductions are going to be phased out because of the amount of money you make. And what you have to do is you have to take a look, depending upon where you are and what you're doing and so on, as to whether or not it makes sense to bunch your itemized deductions in order to minimize the amount of itemized deductions that are going to be lost in a phase out. So first thing you have to understand is that your phase out starts if you are joint adjusted gross income of $300,000 and single of $250,000. Now, there are some itemized deductions that receive favorable treatment, and there are some that do not. Now, state taxes, real estate taxes, state income taxes, sales taxes, depending upon what you do and so on, your charitable donations, your mortgage interest, those types of itemized deductions are all subject to phase out. Now, I bring that up because what I found very interesting when this law came into being at the end of 2012 is that gambling losses are not subject to phase out. Now, what this pointed out to me is the importance of lobbyists, the importance of legislative liaisons in going out and making sure that things are protected. I don't know how Congress thought that putting an additional tax on charitable donations and not on gambling losses made sense, but that's the way the law is written, and it's very, very important you take a look at this and make sure you understand what you're doing so that you don't go out and lose how much you're going to lose here, because what happens here is that you're going to phase out 3% of the excess, so that basically, let's suppose that you have adjusted gross income of $1 million and you're married filing jointly. So if you have $1 million there and $700,000, therefore, is going to be subject to phase out, $700,000 times 3%, you're going to lose $21,000 of your itemized deductions, which is why we want to talk about bunching and minimizing the amount that we lose through our itemized deductions. The other thing that's going to wind up being phased out is your exemptions. So those of you that have kids, the same limitations apply, the same phase-out levels apply for exemptions as for itemized deductions, but this calculation is a little bit more skewed. Basically what happens for each $2,500 over the limit, you lose 2%. So that for your itemized deductions, I consider that about a 1% increase in your marginal tax rate. This is about 0.75% increase in your marginal tax rate. So as you're writing down on your little piece of paper what could be your effective marginal rate, you've got 1% for itemized deductions and about 0.75% for your exemption amount. So if you've been adding all of this up, all right, what you're coming down with is you're sitting here and saying that we have a marginal effective tax rate for individuals of somewhere between 44 and 45%. Now compare that to the 35% top marginal tax rate that you have for a C corporation. What we had seen for the last 20 or 25 years is the maximum effective tax rate for individuals and for corporations was about the same. We now have almost a 10% or approximately a 10% differential. I'm not recommending that for that amount that we change doing what we're doing. We're going to talk about that a little bit more at the end. But you should understand that there is now a significant difference in what you have in place, and you should understand that that now exists. I don't want to spend a lot of time talking about the Affordable Care Act, about Obamacare. As all of you know, almost all of you, with the possible exception of maybe a one-store operator, almost all of you are large businesses. You're going to have in excess of 50 effective full-time employees. Full-time employee is anybody that works 30 hours or more, and after that there's calculations that you do, and you've had plenty of seminars about that to determine who is a large employee and isn't a large employee, so I don't want to go into that in any great detail. What I do want to go into in detail is the discussion of measurement and stability periods. All right? Because this is very, very important, because especially in this industry, you have employees that you've hired, right? And you don't really know whether or not they're going to be full-time employees or part-time employees. They're what we call a variable hour employee. The number of hours they're going to have is going to vary from week to week and month to month, and it's going to vary. So what you're supposed to do in order to determine where these people fit in as to whether or not they're full-time employees and therefore are going to have to provide them with insurance or pay a penalty for them in 2014 is you're going to do something called a measurement period. And during this measurement period, which can be anything between 3 and 12 months, you're going to measure whether or not they average 30 hours or 130 hours a month. Now, most people are recommending that you use a 12-month measurement period. That's the thing that I've pretty much seen most people recommending, and that's fine. What is important to understand is the length of time of the measurement period is also going to affect the length of time of your stability period. Why is the stability period important? What happens with the stability period is that means that if you determine during the measurement period that an employee is a full-time employee, they're going to be considered a full-time employee even if their hours are reduced during the stability period. So if you have somebody that is determined to be a full-time employee during 2014 during the measurement period and their hours are reduced in 2015 during the stability period, you're still going to have to provide them with insurance or pay a penalty for them. That's really important. Now, there are several, and again, I haven't discussed it with all of them, but there are several payroll tax services that are set up to assist you in doing this, that have things all set up in order to be able to help you determine for your variable employees who meets what. You should talk to them. If not, if they can't help you in this area, you're going to have to keep track of it yourself, and it's a little bit of a pain in the butt. The other thing I want to talk about, just because I think it's important that you understand it, and I know that you've discussed it in some of your McDonald's Obamacare situations, but I want to bring up the 9.5% affordability standard that is going to come into play in 2015. What's important to recognize here is that by law, the affordability standard is 9.5% of the family income. Unfortunately, you have no way of determining family income. You can't ask your employee how much they make on their second job, how much their wife makes, how much their interest, dividends, and so on make. So basically, the IRS has come in and they've said, well, instead of doing all that, you can just take the amount that's in box 1 of the W-2 and use that, which is clearly less than what their total income is. But that's what they provided. The 60% test, that's the minimum credible insurance test that, in order to determine the amount of insurance that you have to provide. There's all kinds of discussions that are going on right now with regard to what is happening with some of the people that have lost their insurance, whether or not that insurance will come back or won't come back, and who will come back for, whether it will only come back for people that bought their insurance individually, will it come back for people that lost their insurance through an employer. We don't really know what's going on. I've been in discussion with some people in Oak Brook about this and some people down in Washington, and there's all kinds of things going on. We really don't know what the answers are right now. As things become clearer in the next week or so, 2 weeks, we'll let you know how that's coming down. As you all know, penalties have been postponed for businesses 2015, but we want to make sure that you understand the importance of your measurement stability periods. Worker classification. I don't know a lot of situations where this comes up in McDonald's land, but I want to make sure that you're very, very aware of it. What the Department of Labor has done is the Department of Labor has asked for money in their budget, because what they want to do is they want to distribute some money to the states to help the states determine by audit whether or not a worker is an employee or an independent contractor. Why is that important? as an employee, this person has withholding, and they have all kinds of other things there, including all of your ACA, all your Obama issues, whether or not this is qualified for insurance, whether or not penalties have to be paid. The DOL is helping states to do that. The IRS has already indicated that they intend on most of their audits to take a long, hard look at this going forward in the future years. It is something that is very, very important. If you have questions as to how a worker should be classified, there is an article that is coming out in the AICPA's tax publication, the tax advisor, is coming out in their December issue, that's written extraordinarily well by a brilliant person, me, and we will be able to distribute that after the AICPA publishes it in December. We'll have it available on our website or distributing it to people to help you understand what's happening in that area. If you have questions about worker classification, feel free to give me a call. Feel free to call somebody in our tax department. It's very, very important because the IRS and the Department of Labor and the states have already indicated that they're coming at the people with great big hobnail boots in this area. It is further important because you have to remember that a responsible person, and a responsible person is the person who can make decisions as to how your money is paid and whether or not the taxes are paid. If there is withholding taxes that should have been withheld on a worker that is misclassified, a responsible person is personally liable for that. And that means they are coming after you. I read tax cases every day. There was one that came down after the tax court today that said this person is a responsible person. Even though they didn't sign the checks, they determined how the money was being spent. They are responsible. The IRS was absolutely right in going after them personally and making them pay all of the taxes that should have been paid by this worker. My last couple minutes here, I want to talk about tax reform and choice of entity. And I want you to pay attention to this, and it is something that we'll be making you aware of as the year goes on. Again, we don't think there's anything that's going to happen significantly in tax reform this year or in the early part of next year. We think if tax reform is going to happen, it's going to happen at the end of next year or after the election in 2015. Most people think that there is a very legitimate chance that there is going to be very, very significant tax reform that is going to really change the way a lot of things are done. The reason I want to talk about this, and the reason that I have there the little dash that says choice of entity, is that I want to talk about President Obama's concept of tax reform. What President Obama wants to do, and I'm not picking on the president, I mean, this is his concept, is he believes that the corporate tax rate, C-Corp tax rate, should be reduced to somewhere between 28 and 25%. He does not think that the individual tax rate, and we just talked about the fact that your marginal effective individual tax rate could be as high as 44 or 45%. So what we might see in the future is we might see a difference of almost 20% between that for a C corporation and that for an S corporation and that for an individual. All of a sudden that gets my attention. And what we should do and what we can't do, it is not something we're going to talk about a lot right now. There is about a 10% gap right now. I am not suggesting to anyone that that is enough to make the change. It is clearly a significant amount. It is something that, especially in a growing organization where you have to retain earnings within your organization for future expansion, for MRPs, for new equipment, and so on and so on. It is something that we have to be aware of. It is something we can talk about. But right now, I am not suggesting to people that they move away from the pass-through entities, from the partnership, LLCs, and S corporations. I think that's right where we belong right now. But it is something that we will be keeping track of in the future as we move forward. Those of you know we have all kinds of newsletters. You go out to our website. You can sign up for our newsletters. I'm hoping that you all get them, as well as you sign up for our blast emails that, as important things come down, we make sure people are aware of them. We're also on all of the social media environments, and you can sign up and take a look at things there. Obviously, there once again is my contact information, along with funny little initials that, don't mean anything. But all my information is there, and you can email me at either email. I check both of them on a pretty regular basis. I also check my voicemail back in the office pretty regularly. But once again, I have no problem with people picking up the phone and calling my cell phone, which I did turn off while we were doing this presentation. But I have no problem with people calling me on my cell phone up here to discuss anything that you have that is of issue. There's all the initials for all of the different social media things that we're on that you can reference for us. There's our disclaimer to keep all the attorneys and everything happy. Once again,
Mike, if I may, I'd like to just add in too, I appreciate the time today that everybody took as well. One of the things I do want to mention is, education to the McDonald's owner-operator system is extremely important, and we take these types of presentations on the road as well, visit very, very many co-op meetings, ROAs. I've spoken at 3 or 4 this season alone, and we come to regions and put on financial boot camps. So, if there's any interest out there, we're more than willing to come and provide the education that you think that your owner-operators need in your regions. Obviously, a lot of important information here. We also believe that business planning and action plans and next-gen planning and the like are all very, very important. So if anybody has any questions, feel free to reach out to Mike, or you can also reach out to myself, Mark Keshgagian, at Gray, Gray & Gray. Again, thanks for your support today. Thanks for listening in, and look for our next webinar coming up real soon.
Thank you, everybody. And once again, you have my contact information where you can reach me. And have a good Thanksgiving and happy holidays.